Disclaimer. This podcast is for FCA authorized financial advisors only and is not for retail clients. The views expressed in this content and all other content on this channel are those of the individual speaking and do not constitute financial advice or a recommendation to invest in any product, asset, or strategy, including those discussed in sponsored segments. This content is for educational purposes only. Always do your own research and consider all relevant risks before making any investment decisions.
So we began with financial education, recognizing that nobody knows about money. Most adults are financially illiterate. Our attitude was Wall Street is designed to intimidate you and confuse you to make you their hostage. My first reaction was my journalism hat, which is to ask why. You're telling me to do X. Why? And so I became a heretic pretty quickly. Our advisor's job was to serve the client first. You do well by doing good. It's not very complicated. Nobody goes looking for Bitcoin. Bitcoin is introduced to you. Bitcoin is not complicated. It's very simple, very easy to understand if you just spend a little time with it. Most have no idea what it is. They have preconceptions. Most of those conceptions are wrong or outdated or flat out false. Bitcoin is a technological innovation unlike anything that we've seen. For the first time, institutional investors are engaged. Bitcoin is not a speculative bet. It's a 2% investment in a diversified portfolio.
It's my pleasure today to welcome Ric Edelman to the Bitcoin IFA podcast. Ric is widely known as the most successful financial advisor in the US. He founded the US's largest financial planning firm, which manages $300 billion in assets for 1.4 million families. And Barron's magazine ranked him the #1 independent financial advisor in the US 3 times. Ric has written 13 books on personal finance, and his daily show was ranked in the top 1% of all podcasts. And Rowan University's Ric Edelman College of Communications and Creative Arts is named in his honor. Wow, Ric, what a bio. How are you today?
Doing very well. Good to be with you.
Well, look, thank you for coming on. It certainly sounds like you've had a hell of a journey. So talk us through your financial advice journey.
It's an unusual one, to be honest with you. I did not enter this industry the normal way. I don't have a business degree. I used to brag that I got through college without ever having taken a business course. In hindsight, I think that benefited me. I never was brainwashed. I was a journalist. I was a communications major. And as a journalist, they train you really to just do two things. One, learn how to ask good questions. And then two, learn how to explain the answers in plain English. And so that's what I did. And as a journalist, I started writing in the financial trade press, and that's what got me involved in the financial industry. My wife and I, as young newlyweds, wanting to buy a house like every other newlywed, we recognized we should talk to a financial advisor and get some help. Turned out that advisor was a crook. He told us to lie on our mortgage application, which is a felony. And instead of giving us the advice we needed, which was you're not ready to buy a house, he said, in order to buy the house, lie. And it so infuriated us that we said, you know what, why don't we learn how to do this ourselves and then teach others what we've learned? So we quit our jobs. I quit my job as an editor and writer. Jean quit her job. She went to work for Payne Webber, a major brokerage firm in the US back in the day. She went to learn the back office of the business. I handled the front end of the business, dealing with clients and advice. And we opened our little shop in 1986, and the rest is history. So we began with financial education, recognizing that nobody knows about money. Most adults are financially illiterate. And so we began by teaching young parents how to save for college for their children. And we began by doing elementary school seminars throughout our area. That led to my being invited onto the radio. That led to my getting my own radio show, which was eventually the #1 personal finance radio show in the nation. I hosted that for 32 years. Won all kinds of awards as one of the top radio hosts. That led to my writing books, and I'm the #1 best-selling author of personal finance with 1.2 million copies in print in 8 languages. That led to television gigs. I was on Oprah 5 times. I've been on every major news network. I ended up hosting my own television series, 3 of them, produced 6 specials for public television in America, on and on and on. And along the way, just helping people understand how money works, how they can make it work for them, giving them advice in their own best interest in plain English with a dose of humor tossed in. And that was pretty much the journey.
That's amazing. That's an incredible journey, and yeah, very unconventional. But it sounds like the whole thing was just built on a foundation of morality, values, and integrity. Is that right?
Very, very much so. Our attitude was Wall Street is designed to intimidate you and confuse you to make you their hostage. When in fact the money is not very complicated. It's really easy to understand, and it's really easy to do what you need to do in your own best interest. The problem is if Wall Street were to convey that knowledge to you, you would no longer need them the way that they want you to need them, which means you wouldn't pay their fees, you wouldn't buy their products, you wouldn't do what they want. And so the whole focus was to empower you, to provide you with financial independence. It's far easier to obtain than most people realize. And that's really, Dan, the whole focus of what we try to do is help people understand how money works and how you can make it work for you and your family.
Amazing. Was a bunch of that evidence-based investing, index, cheap, low-cost index funds, that kind of thing?
Well, because of the fact that I entered this business with a journalist lens, uh, we never joined another firm. We started, my wife and I, by building our own little enterprise. And every time I encountered colleagues in the industry and learning what's the advice that people are getting, what's the advice that Wall Street is issuing, my first reaction was my journalism hat, which is to ask why. You're telling me to do X. Why? And I never got satisfactory answers. The most common answer I got was, this is the way we've always done it, which is the worst possible answer anybody could ever give. The second answer that I got was because it's profitable for us. No regard to what's beneficial for the client. It was profitable for the advisor, big commissions they could earn, or for the firm, which earned big fees in managing assets or custodying assets or what have you. And so I just challenged the authority by asking why. And the first place where this became a big deal was in the subject of mortgages. Everybody has a mortgage on their home and everybody hates it. The conventional wisdom was to pay off your mortgage as quick as you could and own your home outright. It's the American dream, owning a home outright. And I just asked the question, why? If I could get a mortgage at 5% on a tax deductible basis, why would I want to pay that off when I can invest money into the stock market earning 10% a year, earning a capital gains tax as opposed to an ordinary income tax? I just didn't make any sense to me to pay off a mortgage. It seemed to me a wonderful arbitrage opportunity. And so I became a heretic pretty quickly. I became very well known very fast for being controversial by offering advice to clients that was very different from what the rest of the machine offered. We told people never to buy muni bonds. We told people to invest in index funds as opposed to actively managed funds. Index funds, which are far cheaper, far more tax efficient, far better in performance, far lower in risk than the schlock that Wall Street was selling. We became one of the very first users of ETFs in America when it was not at all something that anybody thought had any staying power or legitimacy. And so I was developed a reputation pretty quickly for being innovative, for being a futurist, for being a forward thinker, of providing advice and recommendations that made common sense to the individual, but were counterintuitive and contradictory to what the Wall Street machine was advocating. And the message was well received by the American public, which is why my radio and TV shows and books were so popular and why we became the largest advisory firm in the nation, as people would reach out to us on a regular basis seeking our help because what we said, it was common sense, it was easy to implement, and it was in the client's best interest. So what has astonished me, Dan, is that the rest of Wall Street doesn't act that way, because we've proven how easy it is to attract clients and assets, which is what Wall Street wants to do. But if you would simply do what's in the client's best interest, you'd be amazed how effective that is, as opposed to trying to sell them crap that only serves you instead of them.
Very true. Perhaps that's a short-term versus long-term thinking, though, right? Wall Street and typically the financial centers want to make next quarter's buck. They're not looking to build lifelong relationships with people based on common sense.
It's unfortunately all too common and too true. The rulemaking, the way advisors are regulated, the rules they follow are not designed to serve the client's long-term best interest, to your point. It's designed to make a quick buck, generate a high commission today, to boost this quarter's reports for Wall Street. And there's a hierarchy. There's the shareholder, there's the firm, there's the advisor, and at the bottom of the totem pole is the client. And it's the exact opposite of the way it ought to be. And our attitude was, we're not going to pay any attention to the shareholder. We're not going to give any concern to the firm or the advisor. Our advisor's job was to serve the client first. And we knew if they served the client first, the advisor would be well compensated, the firm would make a profit, and the shareholders would be happy. So, you do well by doing good. It's not very complicated.
Yeah, you're right. And it all just sounds like common sense. So look, this is a Bitcoin podcast, and lots of what you've just talked about there, I'm sure we're going to touch on here because it kind of falls into the same category. I think we both agree. But before we start touching on that, everyone's against Bitcoin until they're for it. What's your Bitcoin story?
I was never against it, which is interesting. I didn't realize this in the beginning, but I eventually maybe realized, to your point, most people, nobody goes looking for Bitcoin. Bitcoin is introduced to you. You come upon Bitcoin. And that was true for me too back in 2012. And people asked me, have you heard about this new digital money? And I was like, digital what? It made no sense. I didn't understand it. I didn't see the point of it. But the people talking to me about it were really smart people. And rather than being the kind of person who rejects out of hand new ideas, my attitude instead is to be focused on curiosity. Again, it's that journalist mindset, to understand what you don't understand. And so my attitude was, if these people get it and they're excited about it and it doesn't make any sense to me, then the flaw must be with me, not them. So I need to learn more about this. So I spent much of 2013 jumping down that rabbit hole to try to figure out, what is this? Is there a there? And I needed to reach a decision. And it didn't take long. It doesn't take long because Bitcoin is not complicated. It's very simple, very easy to understand if you just spend a little time with it. And I pretty quickly reached two conclusions. First, Bitcoin is a transformative technology that is going to alter the global financial system in a profound, impactful, and positive way. Second, the vast majority of the financial services industry is unaware of that fact. And so I began talking about Bitcoin and helping people learn about it. Did this on my radio show, did this in my own firm, did this wherever I could. I eventually, in 2015, created DACFP, the Digital Assets Council of Financial Professionals, DACFP.com. We have trained tens of thousands of financial professionals worldwide on understanding crypto. What is Bitcoin? What is blockchain? How does it work? Why should I care? How do I integrate it into a portfolio, etc. We ended up creating the CBDA, the professional designation certified in blockchain and digital assets, which has now been attained by thousands of advisors in 37 countries. And this is an online course with a world-class faculty that the first half teaches you about the tech, what is Bitcoin, what is blockchain, how does it work? The second half is all about practice management, the investment thesis, portfolio construction, crypto taxation, compliance, regulation, and how to explain this to your clients, how to get them to understand what this is, how to overcome their objections as well. And we just do a massive amount of training, not just with advisors and investors, but with firms, with boards, with C-suites, with pension funds and endowment funds to help them understand what all this is, because as you well know, Dan, most have no idea what it is. They have preconceptions. Most of those conceptions are wrong or outdated or flat out false. And it's all preventing people from engaging in this revolutionary technology that is transforming global commerce on a scale we haven't seen since the invention of the internet 30 years ago.
Oh, can I invite you into my workshops and webinars because you're articulating all of this better than I do? But yeah, we're completely aligned on that. What are some of those misconceptions that you're still seeing?
Oh, they have evolved over the decade and a half that Bitcoin's been around. In the beginning, go back to 2012, 2015, people used to say things like Bitcoin's bad for the planet, or the only people who use Bitcoin are criminals. Um, those objections have gone by the wayside. Nobody says that anymore because everybody realizes that that's nonsense. Now there's a new set of myths, of objections that people raise. I wrote a white paper in January, which you can get at DACFP.com for free, on the 6 misconceptions that exist today. And I'll run through the list for you real quick. We can talk about any of them if you like. Number one, I don't want to invest in Bitcoin at 120,000 because I'd have to admit I was wrong. I should have invested at 50,000, at 30,000, at 10,000, at $10. I didn't. And so to buy Bitcoin today, I'd have to admit I was wrong, and people hate to do that. So that's the biggest number one problem. Number two, by extension, the 115 or 120,000 Bitcoin, it's too late. I missed it. Bitcoin's too high. I blew it. I missed my opportunity. That's a huge misconception. It is not at all too late. Number three, Bitcoin is too volatile. That is an absurd comment, often cited by people as reasons they don't want to buy. It's totally false. Bitcoin is not as volatile as you think, and it's certainly not too volatile if you understand how to manage money correctly. Number four, quantum computers are going to hack the Bitcoin blockchain and destroy it. That's one of the funniest, silliest, and frankly dumbest things I've heard people say lately, and I hear it a lot. Number five, Bitcoin's nothing but a pump and dump scheme. People are talking it up so they can cash out quick. Beyond silly in that commentary. And number six, Bitcoin is a speculative bet, and I don't like to speculate with my clients' money. This one is dangerous because it makes you sound smart and careful and proper and prudent and professional, safeguarding your client's money. But in fact, it demonstrates you don't know what you're talking about, and you're actually harming the very client you're purporting to help. So those are the six current falsehoods that we see people saying on a repetitive basis. And I try really hard to help people understand why each of those statements are inaccurate.
I do exactly the same in my workshops. I would really love you. Let's dig into some of those. Let's start with the sixth one, because I think that's the one, my business model is training financial advisors on Bitcoin, because I've chosen that for a couple of reasons. Firstly, I used to be a financial advisor. Secondly, I believe that Bitcoin is a net positive for the world. So financial advisors are an excellent distribution model, right? There's financial advisors look after about 3 million families in this country, and there's about 30,000. So if I can reach 30,000, I'm actually reaching 3 million families, right? So those are the reasons that I've gone into that, and I'm facing all of those challenges that you've just run through. But that number six is the one. It's probably one of the most difficult that I struggle to overcome in terms of providing a coherent argument as to why they should be doing it. So could we focus on that one first? Hi team, a quick interlude to ask, what if you could offer your clients Bitcoin exposure on a regulated investment platform? Because that's what my friends at P1 have done. They've created a discretionary model portfolio invested into companies with significant operations in digital assets, available within general investment accounts, ISAs, and pensions, and managed by award-winning investment professionals. With P1's digital assets portfolio, you can access a professionally managed portfolio of listed companies powering the digital asset economy, such as miners, blockchain infrastructure, payment services, and listed companies with Bitcoin treasury strategies. It's Bitcoin and digital asset exposure built for regulated advisors. It's diversified, actively managed, and with full transparency. P1 created the portfolio for advisors who see the long-term potential of Bitcoin and the digital asset economy, and who are starting to look at how best to facilitate exposure for their clients. It is packaged in a way that fits into an advisor's day-to-day investment advice process. So if you're an advisor who wants to offer digital asset exposure without the operational headaches, visit the URL in the show notes or use the QR code on screen. P1, bridging traditional finance and digital assets. Only available on the P1 platform and via regulated financial advisors, and the value of investments can fall as well as rise, and you may get back less than you originally invested. Now back to the show.
Sure. The premise is that advisors want to do a good job for their client. They want to protect their client from unnecessary risk. They don't want to speculate. They want to invest. When there are two very big differences. Buying a lottery ticket is a speculation, but making an investment is a prudent act. And advisors want to be prudent. They don't want to be foolhardy. General George Patton said it best. There's nothing wrong with taking risk. That's quite different from being rash. And advisors like to follow that and adhere to that observation. And because of that, advisors focus on modern portfolio theory, the Nobel Prize-winning investment strategy created by Harry Markowitz back in the early 1950s that recognizes that investing is as much about risk as it is return. That how much risk we take to get a return matters. It's not just the return itself that matters, it's the risk we took to get there. Which is why we hate taxi drivers who go 80 kilometers or 180 kilometers an hour. How much risk are you taking to get me to my destination? I'd much rather you go slower and safer than take a big risk. So we recognize it's all about risk management. And that means diversification. This is what Harry Markowitz championed. The way you reduce and manage risk is by diversifying. Don't put all your eggs in one basket. Put your 12 eggs in 12 baskets. This way, if one basket breaks, you still got 11 left. And this is why advisors like to recommend highly diversified portfolios. Stocks, bonds, real estate, gold, oil, commodities, foreign assets, you name it. The more broadly we can diversify, the safer we are. And that is what makes the statement that Bitcoin is too speculative to own a silly statement. If you believe in modern portfolio theory and you believe in portfolio rebalancing, then you immediately recognize the importance of diversification and the fact that the more broadly you diversify, the safer the portfolio becomes. Therefore, Bitcoin belongs in a diversified portfolio. If you believe in diversification, you should own everything, even assets you don't understand or assets you don't like. In fact, any diversified portfolio already has assets you don't understand or don't like. There isn't a client in the country who can explain derivatives or commodities, but a diversified portfolio owns them. There isn't a client in the country who can explain why they own assets they don't like. For example, tobacco companies or nuclear companies or defense contractors, or you name whatever attitude it is you have about a given subject, you own them in your portfolio because you recognize the importance of owning everything. And if you're going to own everything, then you literally have to be willing to own everything and not make a decision about what not to own, because as soon as you do that, you're violating your own dictum of diversification. And that is why Bitcoin needs to be included in that broad array of assets that you have in your portfolio. Because we know that the more broadly the portfolio, some assets will zig when others zag, and that helps to reduce the overall risk and volatility. Which raises the final point. The way you build that diversified portfolio is by acknowledging how much of a given asset class is representative, meaning what's the size of the stock market, what's the size of the bond market, what's the size of the real estate market, what's the size of the gold market, the oil market, the foreign market, etc. And what you discover is that on a global basis, The stock and bond market together are worth somewhere in the neighborhood of $300 trillion. The real estate market is worth about $300 trillion. Those three by themselves are worth $600 trillion. Bitcoin by itself is worth $3 trillion. In other words, Bitcoin is 2% of the global market. So if you believe in owning the market, and you're not making a bet of any kind, you just want to own a representative portion, you would have a pretty large piece of stocks, a pretty large piece of bonds, of real estate, and a small piece of Bitcoin. 2%, maybe 3% of the allocation, which is why you routinely hear people saying you should have low single digits in Bitcoin. You should have 2 to 5% of your portfolio in it. It's because it represents 2 to 5% of the global value of assets on the planet. If you're not doing that, you're the one who's speculating. You're essentially shorting Bitcoin. You're arguing that you are so smart, you think Bitcoin's going to fall in value, and that's why you don't want to own it. You're not making that attitude about stocks or bonds or real estate or gold or oil or commodities. Why are you making that deliberate statement regarding Bitcoin? It's simply because you have a bias you're unwilling to admit or acknowledge. And so our attitude is Bitcoin is not a speculative bet. It's a 2% investment in a diversified portfolio. The speculation is not allocating 2%. And most people don't realize that that's what they're doing.
That's exactly how I articulate it. So I have, within my workshops, I have a slide that shows, in the UK, we have a podcast called Trap. It's called the Real Advisor Podcast, and they talk about the great companies of the world, right? That's been the Ingenuity, Wealth Engine. It's, they espouse very, very large allocations to global index funds, much larger than a 60-40 portfolio. For some in accumulation, you're looking at 100% global equities, right?
Sure.
And so I show the great companies of the world. I show Bitcoin's market cap versus, right, was currently fighting Amazon daily for fifth and sixth place. And I show, look, if you've got bare minimum, if you're in a diversified portfolio, sharp of the sharp ratio, said the only risk is not diversification. So if you look at the allocation within your client's portfolio to Nvidia, Apple, Amazon, it's probably around the 1 to 2% range, right? And those are, that's probably somewhere between 5 and 10% of your overall portfolio is those 7 stocks. Bitcoin's just the latest one. I mean, it literally sits between Microsoft and Amazon, or between Amazon and whatever 7th, depending on the day. So yeah, it's I absolutely love the way you've just articulated that. You're absolutely correct, and I am, because of the difficulty. So I'm all in on Bitcoin. I can't advocate anyone else goes for that, right? But even to just start having conversations with financial advisors here, I'm having to say, look, you need to be looking at 1 to 2%, because as you say, that's where it represents in terms of is it $900 trillion in assets globally total, and Bitcoin is 2 trillion of that. So it's, it's representative of, a portfolio. So we start at 1 to 2%, but it's actually something I wanted to touch on because you've recently released documentation that shows that you would recommend, actually, I think it's 10% for risk averse, 25% for mid allocations, and 40% for risky allocations to Bitcoin. I don't know, when we use Bitcoin and crypto, are you using them interchangeably, or do you mean Bitcoin?
I do it interchangeably. I leave it to the investor and advisor to decide whether your portfolio, your crypto allocation should be exclusively Bitcoin, or whether it should be more broadly diversified among other crypto assets, crypto equities, the Bitcoin miners, the crypto banks, custodians, exchanges, the technology companies, the Nvidia, the chip makers that are making the chips that power the mining, et cetera. I leave that to you. But thematically, I'm arguing that your crypto allocation within that diversified portfolio should be between 10 and 40%, which is a big change from just for a couple of years ago for me, and a radical departure for everybody else. When I wrote my book, The Truth About Crypto, which debuted at #1 on Amazon in 2021, I advocated a 1% allocation. And the reason I did that was, think back to 2021. We didn't know what was going to happen to Bitcoin. We didn't know if the governments were going to ban it. We didn't know if there would be investor interest, if there would be consumer demand. We didn't know if there would be technological obsolescence. We had no idea what was going to happen in the future. So my attitude was, if Bitcoin succeeds, it will have such outperformance that a 1% allocation will have a material positive impact on your portfolio. But if it blows up and goes south and becomes worthless, a 1% loss isn't going to harm you. It's not going to interfere with your financial security and retirement. So 1% was an easy way to persuade people to put their toe in the water, to begin their journey down that rabbit hole. And it was simple, safe, non-controversial. You fast forward to today, just 4 years later, and the world has radically changed, largely thanks to Donald Trump, who has reversed all of the President Biden era policies in the United States and created global leadership regarding crypto. So we now know that governments are not banning it. Even in the UK, there is a serious movement toward reversing the positions, because everybody's beginning to now recognize that this asset is here to stay. The technology is proven. It is cyber safe. It is vastly superior to other ledger technologies that businesses use on a global basis, not just in the financial industry, but you've got Reggiano Parmigiano using this in Italy. You've got Breitling Watches, the Norwegian Seafood Association. You've got companies in diverse industries using blockchain technology to operate their businesses faster, safer, cheaper, with greater inclusion than they can without it. And it's not going away. And as a result of this, it is much safer to invest in Bitcoin today than it was just 4 years ago, let alone 14 years ago. And for all of those reasons, I'm arguing that because we are still so early in the adoption and market penetration, that the upside potential is still not yet attained. Even though Bitcoin has hit 120,000, as we record this, we're in the mid-teens. I believe that by 2030, Bitcoin will be 500,000. And my prediction is low compared to many others who argue 1 million or more. We're not seeing anybody talking about a 4x, 5x, 10x return in stocks or bonds or real estate or gold or oil or any other asset class over the next 5 years. And so it represents an opportunity to generate massive improvement in portfolio return. And through a rebalancing portfolio, through a dollar cost averaging portfolio, you can dramatically reduce the risk and improve the returns even beyond a buy and hold. And therefore, even conservative portfolios should have a 10% allocation. As you said, moderate risk should be 25%, and aggressive portfolios 40%.
Wow. There is no way I could go to market with that in the UK yet. So I like to say that, within so one of the arguments that someone put forward for Bitcoin was that their clients will benefit from Bitcoin when the great companies of the world adopt it. And I said, I have to agree. I'm like 100%. And guess what? They already are. Like, if you own any kind of index fund, you've definitely got Coinbase. You've definitely got Tesla. You've probably got Mercado Libre in South America. You've probably got MicroStrategy. So you've already got Bitcoin within your index fund. Your clients are already benefiting from it. But what I like to do is transport them back to like 2017, 2018 and say, look, imagine you could invest 1 to 2% of your client's portfolio into the underlying technology of AI, right? AI, the benefit to your client of AI is going to get lost in the balance sheets of Microsoft, Google, Meta, pretty much, right? So those three, maybe Amazon and Nvidia to an extent. But let's say their market cap's 5x, right? Which is going to be really hard. but let's say their market cap's 5x. Let's say their market cap's 10x in the next 10 years. That's still not really moving the needle in your client's portfolio, right? Bitcoin might 10x, might 100x, might 1000x. We don't know. But the benefit, the real benefit, the asymmetric upside is in holding the underlying technology, not having it diluted within the balance sheets of all of these companies. I still try and then say, right, so, you know, a 1 to 2% allocation, as you say, is the bare minimum, but that's really where I feel comfortable, and that's all I'm going to get away with in the UK. Do you feel like a 1 to 2% allocation at this point is still going to move the needle enough, or does it need to be, you know, have more exposure?
Sure. Getting off zero is the key. So a 1 or 2% allocation, 3% is certainly better than nothing. I believe that the more you do, the better you'll benefit. But it is important for people to allocate today. There's no question that everybody will eventually own Bitcoin. The only question is at what price point will you be buying it? Think back to Amazon. We all missed it. Nobody I've ever met bought Amazon in 1999. And you weren't crazy not to. You want to have some fun? Bring up a chart of Bitcoin's price history since inception. We all know what that chart looks like. Now bring up a chart of Amazon's price history for the first 15 years of its life. Those two charts are identical. Anytime you have a brand new technology, nobody knew what Amazon was in 99. An online seller of books? How does that make any sense? Who wants to upload their credit card to the internet? This was insane. Today, of course, we recognize the power, the importance of Amazon and global commerce, and everyone who owns a stock portfolio owns Amazon. The difference is that the vast majority of people paid a lot higher price for their Amazon shares than those 10, 15 years ago. And that's where we are with Bitcoin. You will own Bitcoin. You could have bought it at 1,000 or 10,000 or 100,000. Today you can buy it at 115,000. Are you going to wait until it's 200,000, 500,000, a million before you buy it? It'll still be a good investment even at $1 million on its way to 5 million or 10 million, but it's not going to be as good an investment as buying it today at 100,000. So you have a choice to make. It's not whether you're going to buy it. That's inevitable. The choice you have to make is when you choose to buy it. And if you're not sure because you're fearful that the price of today's 115,000 will drop to 85,000, then simply dollar cost average. Don't make your investment today in a single lump sum. Invest a tenth of it today and a tenth of it a month from now and another tenth a month after that. And over the next 10 months, get your allocation engaged. Do it over the next 10 years. I don't care. But start now. Allocate a very tiny amount of money, an amount of money you don't care if you lose it, like the money you buy on lottery tickets. And do it again in a month, and do it again a month after that, and just keep on doing it. If you continually accumulate, you'll end up just fine.
What do you say to the people, though, that say this is a Ponzi, it's going to zero, it's wasted money, it's all built on, you know, the demand from the next person?
Well, first of all, it's not true because a Ponzi scheme has one person buying to give that money to another person who already bought so they could get out. So it literally doesn't meet the definition of a Ponzi scheme. But to your bigger point that it's a scam broadly, a pump and dump scheme, that it's going, you know, the only reason I'm telling you to buy it is I already own it. I want you to buy it to make the price go up so I can sell. Okay, is that true? Well, you've got dozens of billionaires around the world who are investing in this. You have pension funds and endowments and family offices and sovereign wealth funds and governments. We have S&P 500 companies, Fortune 500 companies that are buying Bitcoin. We have companies that are now known as Bitcoin treasury companies that are just amassing it. Everybody's buying with the intent to hold. Nobody's selling. And no one person or no one entity owns enough of it to move the market. Even Michael Saylor, the world's largest owner of Bitcoin, owns such a small amount of it that even Michael couldn't move the market if he'd suddenly decided to sell. So it's simply Not true. It simply isn't operating as a pump and dump scheme the way some other digital assets you could argue are. Some of the meme coins, some of the scam coins, sure, you could argue that that there is some abuse going on in the crypto marketplace, that there is some inappropriate behavior engaging, and that's why you need to be careful and prudent the way you do anything else. You have the same thing in the stock market. You've got large cap stocks, part of the Fortune 500, and you also have penny stocks that are trading for mere pennies. So sure, you want to be careful, prudent, cautious, and that's why you want to limit where you're investing, how much you're investing. And at the end of the day, you never want to invest anything that you're not willing to lose.
Totally agree. And I love that you've given that differentiation there. I like to talk about that Bitcoin is not crypto. Crypto is not Bitcoin. That, Bitcoin is digital commodity, digital gold, essentially. No central issuer, no marketing team, no lobbying team. All of the rest pretty much have all of those things. And I love Lynn Alden's quote for it. So do you know the one about, so imagine Apple create an iPhone and then 20,000 competitors come along with a buggy knockoff iPhone with an Apple logo stuck on. That's Bitcoin versus crypto. So yeah, totally agree with that. Let's talk about the volatility thing. So I've, within my reading of the content that you've produced recently, I love that you talk about the volatility. You are going to have to experience the volatility to the downside to experience the volatility to the upside. Bitcoin has historically been quite volatile, 3 years up, 1 year down. But you also talk about rebalancing within that, and that, if you rebalance, in fact, I have a direct quote from you in my workshop, which I can't think of it right now, but essentially if you rebalance that volatility, that it's way more positive in terms of like Sharpe ratios and things like that on the portfolio. Can you talk us through that? Hey team, a very quick pause. If you're a financial advisor, wealth manager, or accountant, chances are your clients have already asked you about Bitcoin. And if they haven't, they soon will. Which is why I've created the Bitcoin IFA webinars. The webinars are designed to give you all of the information you need to confidently talk about Bitcoin with your clients. They're on demand, so you can watch them at a time that's suitable for you. They count as 90-minute structured CPD, and you'll get priority access to the Bitcoin IFA community. Head over to thebitcoinifa.com to book your webinar today. It takes less than 60 seconds. Again, that's thebitcoinifa.com to book. Now, back to the episode.
Sure. It's an ironic conversation, Dan, that the very people who complain about Bitcoin's volatility are the people who should be championing it. I find it quite ironic. We know that in the past 15 years, 16 years of Bitcoin's life, it has fallen 70% or more 7 times. Massive volatility. This is an argument that people use for not buying it. Why would you want to put your money into something that is so volatile? But if you understand modern portfolio theory, the efficient frontier, portfolio rebalancing, tax loss harvesting, and dollar cost averaging, if you understand how to properly manage assets and produce a portfolio that will generate positive returns over long periods, you know that volatility is your friend. If volatility was not your friend, you would have all of your money in bank accounts, earning 2% interest, where the dollar you deposited was always $1. We recognize that volatility is a tool. It is a feature, not a bug. It is a tool that improves our investment returns. And what is so funny to me is that when an advisor says to me, how do I explain to my client why they should tolerate Bitcoin's volatility? My answer is this. What do you say to a client who says they're afraid of the stock market because of stock market volatility? We tell them this is why we diversify. This is why we're not putting all of your money in stocks. This is why we dollar cost average, so that we can get the average price of the stocks. This is why we rebalance, so that when stocks go down, we buy more while the price is low. And when stocks go up, we sell some to capture the profit. Everything we do for the stock market investments, we should be doing with our Bitcoin investments. There's no difference. In fact, if you love the stock market because the volatility helps you rebalance, you ought to be ecstatic about Bitcoin because its volatility is even higher. And the more volatile it is, the better for your rebalancing and tax loss harvesting opportunities. So when people say to me, I don't like Bitcoin because of volatility, I'm like, wait a minute. That means you don't like stocks either because they're volatile too. So we need to recognize that volatility is our friend. We need to learn to use it as a tool to improve our risk-adjusted returns rather than being fearful of it. And there's one final thing that we need to recognize. Bitcoin is undergoing a first ever massive change. Most are unfamiliar with this. You cited it yourself a moment ago, Dan, up 3 years, down 1 year. That has to do with the Bitcoin halving cycle, which occurs every 4 years. And if we look at the first 15 years of Bitcoin's life, you're absolutely right. Bitcoin has risen 3 years in a row and then fallen in the fourth year, often badly, 60, 70, 80%. And then up 3 more years and then down again. And this wave has been predictable. It has been routine. It has been consistent. I believe that's over. I don't think that halving cycle makes any difference anymore. And I don't believe the 3 up, 1 down is going to be sustained in the future for one simple reason. For the first time in Bitcoin's history, this wasn't true for the first 15 years, but it's now true today and will remain true forever. For the first time, institutional investors are engaged. For the first 15 years of Bitcoin's life, the only people buying Bitcoin were individuals. Most of them not sophisticated investors. It was the crypto bros, right? It was the anarchists, the people who were trying to turn the financial markets upside down or trying to get rid of fiat currencies to upend the financial system globally. That party's over. That game is lost. The crypto bros need to shut up and go home and count their winnings because they were right, they were early, they were successful, but they're not going to upend the global financial markets. Instead, the governments are involved, the corporations are involved, the endowments, pension funds, sovereign wealth funds, family offices are all involved, the billionaires are involved, and we all know how to manage money. We all know how to produce profits with our portfolios, and we will not allow another 70% drop in Bitcoin. Because if Bitcoin falls 30%, the institutions will say, that's a buying opportunity. They'll buy and create a floor long before Bitcoin ever hits another 70% decline. They've got the trillions of dollars of assets to be able to make that happen. The individual investors didn't have that firepower. So Bitcoin's volatility is reducing. In fact, if you look at Bitcoin's volatility for the past 12 months, it's lower than the S&P 500. Bitcoin's volatility is now less than Nvidia's because of this very fact. And so the volatility that you've been fearful of, it's still there. Don't get me wrong. Bitcoin could still fall 20, 30, 40%. I just don't think it's going to fall 70 or 80% and stay down for years like it did in 22. I think those horror days are behind us. And therefore, you don't have as much to fear from volatility as you used to.
That's a bold prediction. I'm actually a bit of a cycles trader on the side. So I'm a bit of a trader on the side. And I believe in cycle theory. So Bitcoin has a 4-year cycle. So I'm still targeting Q3 next year for some large capital inflows myself. I would love to see it, that we don't get that sort of 60, 70, 80% drop. But then, I would counter that with Amazon. You referenced the Amazon chart. I use that in my workshops, that Bitcoin is more analogous to gold, but I use it as, the initial stages of a tech stock in terms of it's not tulip mania, it's product, an asset trying to find product market fit. Amazon dropped 95% in 1999, but it did that with institutional investment, right? So I still think Bitcoin could see that kind of volatility if we were to see, sovereign debt crisis. Japan started to unwind again. People will grab liquidity wherever they can get it, right? So when there's margin call, in fact, I literally just watched Margin Call, the movie, for the first time this week. I'd obviously
It's a great film.
It's such a good film. I can't believe I hadn't seen it before. I saw The Big Short a number of times. Love that movie, but I'd never watched Margin Call, and kind of scary actually. I highly recommend it to financial advisors listening or watching. But when those margin calls come in, and those guys are coming in and being told, sell everything, we're giving you $2 million bonuses if you clear all of this shit off our books today and just give it to someone else. When that starts to happen, people will go looking for liquidity wherever they can find it. And I don't think Bitcoin will be able to, I don't think Bitcoin will be removed from that, right? So, but Bitcoin will be falling like everything else, right? When
I don't disagree, but that's my point. Bitcoin will fall like everything else, and you're not going to see the stock market falling 80%.
Okay. Yeah, because we have the circuit breakers involved and people see it as a buying opportunity, you mean?
Yeah.
Yeah. Okay.
But
Well,
even if it does, even if those cycles persist, you're still going to be able to benefit from rebalancing. That's the key to helping you get through periods of market volatility. And I think rebalancing is an underappreciated tool for investors.
totally agree. And also, Bitcoin has a 100% hit rate if you hold it for 200 weeks, right? So, someone shared stats with me recently. It went straight into my workshops, which are, if you were super unlucky, if you bought one Bitcoin on the day of every peak, right? So that was $25, $1,200, $20,000, and $69,000. If you literally bought on the day, right? You now own 4 Bitcoin, and as we record this, it's worth $450,000, and it cost you $90,000. So as long as you just hold it for minimum 4 weeks, investable periods in the UK FCA regulations are 5 years, so you shouldn't be investing anything that you're going to need as cash in 5 years. So those line up pretty well. So even if we continue to see those 3 years up, 1 year down, roughly 100% returns in a year up, roughly 50 to 70% decline in a year down, you just need to hold it. You just need to wait.
And that's why this conversation is really more about behavioral finance than economics. It's not a question of how confident are we about the future of crypto. The question is, how confident are we that you'll hang in there when you need to? It's easy to buy when the price is high, and that's why everybody does. The challenge is to hold and buy more when the price is low. And we know from Nobel Prize winning research in behavioral finance that investors are notoriously bad investors. They love to sell low and buy high, the exact opposite of what you're supposed to do. And a good advisor's real value to their client is hand-holding them to prevent them from making that fundamental mistake.
Totally agree. There's a movement in the UK from some people still call themselves financial advisors. Some call themselves financial planners, especially the ones that have moved to cash flow modeling tools. And they are essentially looking at, 30, 40-year cash flow plans and saying, right, you've got these tentpole moments at retirement, and at 80, you want to do this. And, they build all of that in Voyant. Those are planners. And then once the plan is in place, if the output doesn't change when there's a 20% drop in the stock market, well, then the input doesn't change. So you handhold, and you essentially become a sort of emotional, psychological coach as the financial planner, as opposed to a financial advisor, which is what I was, which was essentially just product sales, selling people into certain funds, certain portfolios. Rick, I'm looking at, so I've got the 6 that we went through. So I think we've covered off the speculation. We've covered off the volatility, the massive pump and dump. We haven't touched on quantum computers. We've done the volatility. We've done the it's too late. So the two we've got to cover off: quantum computing and egos, having to admit that they were wrong. So, dealer's choice. Which would you like to cover first?
Hey team, just a quick pause to say a huge thank you. You've given us your most precious assets, your time and your attention. And honestly, it means the world to us. If you've enjoyed this episode or you take value from these conversations, it would really mean a lot if you could like, comment, or subscribe. Those things really help the algorithm and they help the channel to grow. And if there's someone in your life who would take value from this, maybe a fellow advisor or someone just curious about Bitcoin, please send it their way. You never know what it might spark. Okay, back to the studio.
Quantum computing is the most fun. So let's start there. It's also the silliest, so it doesn't take a long time. We've all heard the news that they have now created a quantum computer that they believe can break into any system that will be coming onto the market over the next decade or two. And there's fear that the Bitcoin blockchain will therefore get hacked and all the Bitcoin will be stolen. And therefore, I don't want to buy Bitcoin because of that eventuality. It's a silly risk. It's a silly concern. For a lot of reasons. Number one, it is going to be decades before quantum computers, in fact, get that capability. Number two, why would someone who has such a quantum computer waste their time hacking the Bitcoin blockchain? If they do, all they're going to do is render all the Bitcoin worthless. Because if they steal all the Bitcoin, who are they going to sell it to? Nobody will be willing to buy it because everyone knows it's been hacked and worthless. So all they'd be doing is stealing an asset that is of no value to anybody. They would be much better off breaking into the Bank of America or Citigroup or Wells Fargo bank accounts, which are holding $4 trillion each, because the cash of US dollars will still have a value even if they steal it. That's why Willie Sutton robbed banks. That's where the money is. So they're not going to bother going into the Bitcoin blockchain. More fundamentally, it's going to cost billions of dollars to operate that computer, which means only rogue nations are going to have that kind of funding. China, Russia, Iran, Iraq, North Korea, you name your rogue nation of choice. Why would they go after the Bitcoin blockchain when they can instead go after the nation's air traffic defense system? Or the nation's electrical grid, or our nuclear launch codes? In other words, we're going to have much bigger problems than worrying about our Bitcoin if this were really to happen. And the most fundamental of all reasons we don't have to worry about this, if you can build a way to break into my house by showing up with a 10-foot ladder, why don't I just build a 12-foot wall? In other words, if you can use a quantum computer to break into me, why can't I use a quantum computer to protect me? And that's why people who are worried about quantum computing, I think, really should find something else to worry about.
I like that analogy with the ladder. I had a chat with someone at a Bitcoin conference recently who admitted to being in a job that he probably shouldn't have told me he did. I'm not gonna dox him, but he said exactly the same. So he said, if a quantum computer threatens it, we'll use a quantum computer to protect it. Also, the stats that I like to use in the workshop, we've created a computer with about 100 qubits, which is how we measure quantum computing. It's estimated up to 300 million qubits would be required to hack the wallets, right? It doesn't even hack the network, it's the wallets that are really going to be the risk. So I like to put it into meters, right? So we've built a computer that reaches roughly the height of the Statue of Liberty, hasn't gone past the Empire State Building, hasn't gone past the Pyramids of Giza, hasn't gone past the Eiffel Tower, and it needs to reach the moon. So we're slightly far away.
That's great. The National Institute of Standards and Technology, NIST, in the United States announced that they've already created a dozen algorithms that can defeat a quantum computer attack. So those defenses are already underway. In other words, nobody ever gets hit by a bus that they see coming. We all see the threat. We all know that quantum computing is in our future. We're not standing here waiting to get hit by the bus. We're going to take precautions to protect ourselves. So let's find something else to worry about.
Yeah, totally agree. Especially because all of the first people in Bitcoin were either anarchists, freedom nuts, as you say, or they were, cryptographers. They were, these are smart people who helped to build the Bitcoin network. Then they went and built some other cryptos as well. They know what they're doing. They're going to protect us.
Yeah.
Right. So the last one, the big one. How do we talk to financial advisors who potentially may not be able to get over their own ego and admit that they're wrong?
Yeah, that is the biggest challenge, isn't it? Because we all have a strong ego. None of us want to admit we were wrong. Not to our spouse, heaven forbid. Heaven forbid I tell my wife I was ever wrong about anything. Not to our children or parents, not to our colleagues, coworkers, not to our boss, and certainly not to our client, the ultimate boss, right? So I don't want to tell you to buy Bitcoin at 115,000 when you asked me about it when it was 40. Here's the point. You don't have to admit you were wrong because you weren't. When you didn't buy Bitcoin when it was 1,000 or 10,000 or 50,000 or 100,000, you weren't wrong. You were prudent. Back then, over the last 5, 15 years, we had no idea what was going on with Bitcoin. We saw massive scandal, massive fraud and abuse. We had Silk Road, Mt. Gox, FTX, Terra Luna. We had governments banning it around the world. We had massive uncertainty. There was a lot of criminal activity. There was a lot of unpredictability. And you were prudent in your decision to protect your client from that. You weren't wrong to stay away. You were doing your job. That was then. This is now. And today, the Bitcoin landscape is radically different. We now have government endorsement on a global basis. We now have institutional engagement at an unprecedented level. We have technological verification that this ledger technology works. It is now appropriate to allocate for this very same reason that you didn't allocate 1 or 5 or 10 years ago. So you weren't wrong. You were waiting to become right. And now you are. And now's the time to allocate before it gets to 250, 500, and a million in value. At 115, it's a bargain. And now you can shine by showing your client that prudence in the long run wins.
Amazing. Rick, that's awesome. I'm wary of time. I like to ask the same question to all of our guests, right? As we close out, what's one positive thing that Bitcoin has brought to your life outside of number go up?
It's intellectually fascinating. Bitcoin is a technological innovation unlike anything that we've seen. Many refer to it as Internet 3.0. We've gone from the Internet of people to the Internet of things to now the Internet of money. And it is intellectually fascinating and allows us to engage in conversations of curiosity that you don't find terribly often. And so I find it enjoyable to discuss simply from an intellectual curiosity perspective.
You and me both. Rick, where can people find you if they want to?
The easiest way is at DACFP.com, DACFP.com. We have a lot of content, lots of white papers. We do webinars a couple of times a month. We host our annual crypto conference in the States each year. We do a lot of consulting to advisors, to firms, to boards and C-suites to help them understand what this technology is all about. So happy to help you in any way that we can, not necessarily to persuade you to buy it, but to help you understand the importance of you understanding it.
Amazing. Thank you, Rick. Have a great day.
You do the same, Dan. Thank you.